Hi, I'm Rauld Khleif. Each and every week, I record an interview with a thought leader that I know you're going to get a ton of value from. Now, here on YouTube are the video versions of my podcast, Lifetime Cash Flow Through Real Estate Investing. Now, to make sure you get the latest information, please subscribe and hit the notification bell. Let's get started. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rauld Khleif, and I am thrilled you're here. I know you're going to get tremendous value from the attorney that we're interviewing today. His name is Mauricio Rauld, and I think I actually met Mauricio at a syndication boot camp a lifetime ago. I brought Tiffy, so probably about 8 or 9 years ago. But Mauricio's he's an expert in asset protection. He's an expert in SEC syndication, and will describe what that means. And he does business nationally, so we're really lucky to have him on the show. Mauricio, welcome, brother.
Thanks so much for having me. Really appreciate it.
Yeah, absolutely. So I know that before we started recording, that your focus is real estate syndication. Yes.
Yep, 100% of my practice is real estate syndications, and 100% of my clients are real estate investors. Yeah.
Okay, and do you do it? You do it nationwide, as I said, correct? It doesn't matter where the deal is.
I actually do it nationwide and internationally. I've got a few international clients who are raising capital here in the U.S. for offshore projects, and so I've got deals in Nicaragua and Panama and Belize and some Asian countries. So yeah, international, or certainly all 50 states.
Yeah, because it's federal law, so you can.
That's right.
Practice. So let's do for the new listeners that haven't heard about. Don't really know the nuances between, why a syndication should be, why that path should be taken versus a joint venture. Let's take a few minutes on that. And then guys, if you're thinking, oh, I don't need to hear that, trust me, you want to stay on, because we're also going to talk about syndication as it relates to social media. And we're going to talk about syndication as it relates to raising money or equity for deals and commissions paid on that. So don't leave just because we're going to talk about the basics for you a few minutes first. So let's talk about, just kind of give people a brief education of how syndication, or why these SEC exemptions came to be, and just let's just take
yeah. Yeah, that's a great question. It's actually one of I think the biggest mistakes most syndicators make is they don't realize that the securities or the SEC is involved, right? You're buying real estate. I'm just buying a piece of property. Why the hell is the SEC involved in my business? And the reason is, anytime you take money from an investor where the profits or the returns are generated by your efforts, you are dealing with a security. It's a very broad definition. I don't care if it's an LLC, a partnership, a corporation, a profit sharing agreement, a high five, a handshake. The structure itself is completely irrelevant. Even joint venture agreements, the structure doesn't matter. It's a security. And anytime you are dealing with a security, there's really only 3 things you've got to think about. Number 1, you've got to register that syndication with the SEC. Or number 2, you must find an exemption to that registration, or it's illegal. It's that simple. Obviously, we don't want to do illegal offerings, but keep in mind, illegal offerings are not, Bernie Madoff. It's not just fraud and swindling your investors, which obviously nobody wants to do. It can be things like, and we'll talk about it a little bit today, advertising on social media. That's an illegal activity. That's something you can't do. It could be just getting a little too excited about describing your returns and kind of like really blowing them a little bit out of proportion, or really promising the sky and not really giving proper disclosure. So there's a lot of things that go along with the illegal other than just swindling. Registration, I don't want to say never, but you almost never want to do a full-blown registration with the SEC, because it takes you a year to 2 years to do, and it can take 6 to 7 figures. And so if you're one of the syndicators and you're in contract to take down a building, and how many of you have 18 months to wait for the SEC and their lawyers to approve your deal? It just doesn't happen. So we never register the security. And so we're always looking for an exemption. And that's really the world that I live in. There's several exemptions that we can look at. And that's what I do day in and day out. And luckily for us, as you know, Rauld, there's a couple of exemptions that are pretty popular.
There's some incredible opportunities now that weren't around when I started in this business, and maybe not even when you started in this business. Let's go back for 1 minute to the definition of a security. So if I go buy a building with someone and they are actively involved, do I need an exemption to the SEC rules?
No, if you're doing a deal with somebody else and that person is active,
Yes.
That means that the returns are generated by both of your efforts. It's not just generated by your efforts. So one person or maybe two. And actually the SEC has said up to about five, like 4 or 5, you can argue that you're all active. If you have 10, 20, 30 people, there's no way you can argue that we're all active, right? There's something going to be passive. But if your investors are active, you're not dealing with a security. You're basically started a business. You're doing a joint venture. It's just like starting a business.
Yeah. See, back when I was real young, I did a lot of property with partners 50-50. And I did most of the heavy lifting, but they were involved in the decision making. When we sold, how much money, you know, if I spent more than a certain amount, I had to get their approval, things of that nature. So they were absolutely active, and I didn't have to syndicate. And I just want to make that clear to people. So, you know, and sometimes these joint ventures can be very large. I mean, multi-million-dollar deals if you hit a high net worth partner. But okay, so back to syndication. So the initial exemption that I grew up on was the 506B program. And so why don't we talk about that first, then we'll go into the other two real quickly, and then we'll get into some of these other nuances.
Yeah, so the 506, and this is probably as technical as we're going to get, 506 falls under the Reg D. You probably heard of that, the Reg D exemptions. And the reason this is such a popular exemption that 95% of the people use is really twofold. Number one, it's a safe harbor, which means if we comply with all these enumerated things, we are assured, we're guaranteed that we're compliant with the exemption. We don't have to do any guesswork. It's not reasonableness, you know, all those nasty legal terms.
And when you said 95%, are you talking about Reg D or are you talking about 506B?
I'm talking about 95% of people use Reg D as their exemption.
Got it.
Reg D as exemption.
I want to be real clear on that.
Yep. And so as you know, with 506, back in the day, you're talking about before 2013, there only used to be one, which is 506 period. Now that's called 506B because now they added a 506C, which we'll talk about in a second. But 506B is a safe harbor. So we're guaranteed or assured of the exemption. The other reason it's very popular is it preempts state law, which is just a fancy way of saying we don't generally have to worry about the states. We still have anti-fraud provisions. We still can't be Bernie Madoff, but we don't have to go hire an attorney in every single state. We don't have to pay that money. You can rely on one attorney like myself, who's approved obviously to work at the federal level. So that just is very attractive. And a lot of the other exemptions may be somewhat attractive, but then you realize, man, I got to go to 3, 4, 10, 15 different states, which is the nightmare. So that's why it's popular. Now, to give you kind of the highlights of what are the elements of a 506B and why most people use it. Number one, you can raise an unlimited amount of money. Right. So this is the reason why even the big boys, the JP Morgans of the world, the Goldman Sachs of the world, they still rely on 506B because they have this huge database and they can raise, 1.2 billion, which is the last JP Morgan fund that I saw. They can do that under a 506B, unlimited amount of money. You can take a limited amount you can take as many accredited investors, but you can take a limited amount of non-accredited investors. And just so we don't leave anybody behind, an accredited investor is anybody who has a net worth of $1 million, excluding their primary residence, or has earned $200,000 the last couple of years with a reasonable expectation of earning that amount this year. And of course, if you're married, that number goes up to 300. So under a 506B, it's very attractive, especially for newbies, because you can bring in your friends and your family, because inevitably one of those people is non-accredited. And so you're allowed to bring 35 non-accredited investors, so long as there's some level of sophistication. The main drawback of 506B is you are not allowed to advertise or generally solicit, meaning you cannot go on Facebook, for example, and go post about your deal and tell the world, hey, I'm raising $1 million to do this, that, the other. You can't advertise.
And this is getting abused, okay?
Oh, my goodness.
Just pay attention, guys. This is a big deal because there are people, I'm seeing people doing this. I caution my students about this all the time. 506B, you can't advertise in any way, shape, or form, period. So
that's correct.
Please continue. So what can a person do?
You can talk in terms of when you're advertising. In general, you have to have what's called a preexisting substantive relationship. That's kind of not the only way. A lot of people think that's the only way. That's like 95% of the time that's what happens. Because but the SEC takes a position that if you have an existing relationship with someone, then by definition, you haven't advertised to them, right?
Before you move on, are there any parameters to define that pre-existing substantive relationship? Any parameters around that? Let me just backtrack a little bit. There's SEC guidance on what it takes to create that substantive relationship, meaning what are the steps that you need to take from taking a complete stranger that you've never met before, that somehow you obtain legally,
putting them through the process so that you get to a point where you've established a substantive relationship.
Can you drill down on that? Can you drill down on the letter?
Yeah. So for example, so this comes out of what's called a no action letter, a citizen VC no action letter. And they go through 6 steps it was. And so if we mirror those are good kind of best practices. So number 1, for example, you want to provide them with a really solid questionnaire. That's probably step number 1. Not just any generic questionnaire. I would analogize it for those of you guys that are in the stock market and want to open an options account or something. Remember all those questions you get if you wanted an options account or a margin account? It's like, what's your level of experience? Have you traded options before? What's your net worth? How much income do you have? How much experience? You're just trying to get information so you can figure out whether this person's sophisticated or not. So that's step number 1. Step number 2 would be certainly some kind of a phone call. I would recommend at least a 15, 20-minute phone call with them. Again, it doesn't have to be you. It could be somebody in your team. But a 15, 20-minute phone call, a meeting would be great, a lunch, a coffee, whatever, but some kind of a personal interaction. Number 3, you'd want to encourage them to take a look at your website, dig around and get information. You want to encourage them to ask questions. You want to do everything that just generally fosters that interaction with that person. So you and me, Rauld, we're talking and I get to know you. The SEC is very clear that there's no magic timeline. It's not like, hey, I do this for 30 days or 7 days or 24 hours. It's really the quality of the interactions. I always I always bring the example that, we do a lot of real estate field trips, for example. And so if Rauld, you and I go down to Belize and spend 3 days together doing, a tour down there, that's going to be much different than if you're just on my email list and I'm emailing you for 2 years, right? So it's the quality of the interactions that the SEC really wants to focus to. And so at some point through that process, and this is just kind of a self-certification part, you say, all right, Mauricio, as of today, I believe I have a substantive relationship with you. I've gone through this process. I've gone through these steps. I've got great interactions. I kind of know you well enough. Today, I have a substantive relationship. You somehow capture that in your CRM, your Excel spreadsheet, however you're keeping track of all this stuff. And then you can offer them a future deal. You cannot offer them a current deal because, again, you have to have a pre-existing substantive relationship, and that means pre-existing to your offering. So once you give them the green, once they turn from a red light to a green light, or however you want to say it, you've got to wait now until your next offering, and that's when you can start, sending them.
That's the piece I think a lot of people are circumventing, is that timeline piece regarding if it's a now deal or a future deal. So I remember back in the day, it used to be called the 3-touch rule. That's how they defined it. Talk to somebody at least 3 times, but now it's defined as a substantive relationship. Okay, super. So that's a great program if you've got a big network or you start developing one. Now let's talk about what I love, which is the 506, a new one that came around after the Dodd-Frank Act.
Yep. So this came back out officially in September of 2013. So I used to say it's a new law, but it's been now 5-6 years or whatever the math is. And what this law did, which was a result, as you mentioned, of the Dodd-Frank, the Jobs Act of 2012, is it lifted the prohibition against advertising. So for the first time, you're now able to advertise and solicit. So everything we just talked about goes out the window. You want to take an ad out in the Super Bowl. You want to do Facebook ads. You want to do a webinar, radio show, whatever. Knock yourself out.
Talk about it on a podcast. Talk about it in the room at one of my live events. Do webinars. It's like the clouds parted, man. It was just incredible.
Yep. Put it on your web. Put the offering docs on your website. Whatever you want. So that became this new exemption called the 506C, as in Charlie. A lot of people call it crowdfunding, which technically isn't correct, but fine, let's call it crowdfunding. Now it allowed you to do that. Now, the main limitation, or really the only limitation, is that you are now limited under that exemption to accredited investors only. So you are not allowed to take any non-accredited investors. They all have to be accredited, and you must take what's called reasonable steps to verify that investor is accredited. Under 506B and a lot of the other exemptions, you can rely on the check the box. You send them a questionnaire, they represent to you, hey, I'm accredited or whatever, and you can rely on that. Under this exemption, you cannot. You've got to take those additional steps. Now,
can you drill down on those a little bit?
Sure. The easiest way to do it, which I recommend to my clients, is get a CPA verification letter. Get that from your CPA. Just make sure the attorney's looking at it. I've got templates or what have you, because you got to make sure that certain things are in there according to the rule. But just send them the template, have them put it on their letterhead, sign it, because obviously that CPA is familiar with your financials or whatever. So that's the easiest way to do it. That can also be an attorney. That can also be a broker. But the CPA is probably the most common way viewing it.
Okay.
for those who either, some of them don't have CPAs, which is a little scary, or some CPAs don't want to do it, so you're left with another group. I would then, and I'll drill down in a second, I would recommend outsourcing that to somebody else. If there's a lot of third-party verification companies that will do this work for you, because now you've got to drill and really request financial records and documentation, which if you've never met this person or just met them might be a little uncomfortable. But essentially, if you're relying on the safe harbor, you're looking at, you know, tax returns, you're looking at W-2s, 1099s, if they're all relying on income. If it's net worth, you're looking at bank statements, property appraisals. A credit report's important because you want to make sure that it's not all about assets, right? Your net worth is assets minus liabilities. So you want to know what their liabilities are.
Do you know a couple of these companies off the top of your head? We could throw them out there.
I recommend, and I have no affiliation with them. I use a company called Verify Invest. Gentleman there called, I think he's got an interesting Jor Law, I believe his name is. And I've been sending people there, and everyone, I've got great feedback. So, but
super.
It doesn't matter who it is, but yeah. And so what happens is you don't see any of those financials. They actually do the verification, send you a letter, and so. Because, you know, again, if you haven't met anybody, it's like, well, I don't know.
Sure. It's hard to ask somebody, hey, show me your tax returns. Just say, we use this independent verifier that does it for us. We don't need to know. I don't need to know that level of detail. So get with them, and then they'll send us a letter we need, and you can invest with us. Love it.
Yep.
All right, so that's the 506C. You can scream it from the rooftops. They just have to be accredited. Is there a limit on the number of investors, number one, and then is there a limit on the amount you can raise?
There's no limit on the amount you can raise. There's no real limit under the exemption, although once you hit 2,000 investors, this is a general rule. Once you hit 2,000 investors, you're probably required to actually do a full-blown IPO. So there's a limitation of that. But God forbid you want 2,000 investors.
Guys, managing your investors is much harder than managing the real estate. I couldn't even imagine having 2,000 investors.
Oh my God, yeah.
So that's the 506C. Anything that you want to elaborate on that, or can we move on? I'd like to ask you.
We can move on. It also preempts state law, which is why it's very popular now. I'm with you, Rauld. When this first came out, I was excited. I'm like, dude, the world's going to open up. The world's your oyster. But for whatever reason, I have a hunch. But for whatever reason, it hasn't really.
Yeah, it's not as big.
It's not as big.
506B. Most people are doing D. And well, most people don't have, a huge reach either. And that's part of the piece. I mean, I'm blessed. I've got this podcast. I just told you we hit 6 million downloads today, which is cool as hell. I showed you, which was a big milestone for us. I need to go throw that out there on social media.
Congratulations.
Thank you. And I've got a Facebook group that's got, pushing 30,000 people in it. And by the way, guys, if you're not in that Facebook group, good God, get in there. It's a direct link is multifamilycommunity.com and direct link to the group. And again, you are the 5 people you hang around with. You want to be around people that want what you want more, and know what it is that you're interested in. And it's just for education purposes. We don't allow any promotion in there at all, even indirect. But go in there to learn, and it's very, very active, which, I mean, we're adding literally hundreds of people a week. So we should hit 30,000 here within probably 2 months. But anyway, so that's the 506C. Now let's talk about kind of the new bellwether, which is the Reg A or Reg A plus. And I know you haven't done a ton of that, but I think Grant Cardone's doing one of those now with a fund. And let's talk about the nuances of that. By the way, let's circle back. Do you mind talking about the average costs to prepare all the syndication documents for a 506B or a C? What's the average?
15 grand, I would say, is the average. 15. But let me one thing I do want to say, because it's a little pet peeve of mine, Rauld. It's so much more than just preparing docs. I mean, that's
I know. Okay, forgive me. I wasn't trying to minimize it by any stretch.
But a lot, and the reason
is actually a great price.
The reason I bring that up is there's a lot of other people that do it cheaper, but all they do is legally docs, and it's like, anyways, it's a pet peeve of mine, but it's such a lot of work. But yeah, 15 is probably good.
No, I'm glad you said that. And I've paid as little as 8 grand and regretted it. And I've paid as much as 25 grand. And so, the other pieces of this, guys, is you need help on the real estate side as well. You need help, with the contract negotiation, the contract review, the financing piece of it, and putting that all together. And a knowledgeable SEC attorney, is just a huge resource in that regard. Now, some attorneys, do you do the real estate piece as well, or just the SEC piece?
I just do the SEC piece, but I am actually bringing somebody in to do the real estate piece because a lot of people like to have the real estate piece under the same roof. So that's what I'm doing right now.
Sometimes that works well. And I've actually had a situation where that didn't work well either. But specialization is important. But okay, so let's talk about the Reg A plus, because this is fairly new and it's kind of cool.
Yeah, so Reg A plus, Reg A's been around for a while. Nobody used to use it, and one of the reasons they didn't used to use it is because it did not preempt state law. We were just talking about this. So if you did a Reg A back in the day before it came out, I forget now how long it's been, 3 or 4 years, you would have to go to every state and make sure you comply. Law. So when Reg A plus came out, number one, originally it was not going to preempt state law, and then at the last minute they changed it. So now it does preempt law. So it becomes a lot more popular. They increased the raise limit from 5 million to 50. So it's not an unlimited raise like 506B and 506E, but you're limited to $50 million, which is a pretty significant amount anyway.
Let me interject one thing. Guys, this state law preemption is huge because most states have some securities laws. In fact, I think they all do in some fashion. And if you do a regular SEC filing like he was describing, you literally have to go to just about every state and get approval from them as well. It's a pain in the total pain in the ass. So
it's a pain, and it's also expensive because you've got to hire an attorney in each state, and you got to pay those attorneys $15,000 a piece, and so you can end up spending $100,000 in attorney fees, if not more.
So
$50 million, which is nice. It does require. Well, let me give you the positives, and then I'll give you sort of the nice. So then the next positive is you can advertise. Obviously, no, not obviously, but you can advertise just like a 506C. So again, you want to go on Facebook and knock yourself out. That's a positive. You are allowed to not only advertise, but you're also allowed to take non-accredited investors, right? So that's like the best of both worlds. You get to advertise and you get to accept non-accredited investors. They still have to be sophisticated. There is some limitation. So I want to be clear. The limitations on the non-accredited as you are limited to 10% of their net worth or their income, whichever is biggest or highest. So there is that limitation. So I want to make sure you guys are aware of that. But the idea that you
net worth or income,
whichever's highest.
Whichever's highest. Okay.
Highest, right. So if I'm a doctor making $250,000 and I've got $600,000 in net worth, you can take $60,000 from that person.
Okay.
So it's not insignificant. So that's nice. And that's why you see, anytime you see somebody, so Grant Cardone is a great example. Anytime you see somebody advertising and they're taking 5,000, 10,000, like little chunks of money, it's a Reg A filing for sure, because these people are, they don't have huge net worths and they want to get involved. And
is there a verification process with that, or is it just a questionnaire kind of thing?
No, there's no verification, but there is a mini registration, which is really the downfall, right? The negative. It's not a full-blown registration, so it's not going to take you a year, 2 years to do it. They say it takes about 6 months to get this through the process. I would say sometimes Grant's a great example. It took him a little bit longer. They put him through the ringer a little bit, but it can take less, but let's just say 6 months. So again, if you're buying a piece of property, probably doesn't make sense. You don't have 6 months in your contract, but if you're putting together, maybe some kind of a fund or something, a portfolio or something where maybe you're not in a rush, then that's something you can look at. But that's the negative. And of course the cost is also a negative. Because you're doing a mini registration, what happens is you first got to get it approved by the SEC. And so you're filing with the SEC, and then you go through this negotiation process back and forth with government lawyers. So it's very much interactive. And as you know, Rauld, the government is very efficient and they do everything super fast and they're really good. So obviously they don't. And so it just takes them a long time for them to review, get back to you, and then you've got to revise it, get it back. So there's a lot of interaction.
Do an audit, there's audit a bank account that has no money in it. It's a stupid.
That's correct. You got to, that's the silly thing. And then once you get it approved, there's some compliance components to it as well. So you've got to do annual reports, including audited. You've got to do a semi-annual report, a current report, an exit report. There's a bunch of compliance. So the cost really adds up, and when I said it's about $15,000, for a Reg D, you're probably looking at more $50,000 to $75,000 for a Reg A plus. So you really, you don't want to be doing $1 million Reg A plus. You want to get, 50 million to do it as large.
Put a bunch of properties in it. Okay. Yeah. Well, thank you for sharing that. So now let's circle back to what I promised you guys when we started this thing, which is what we're seeing on social media. And so let's talk about what you can and can't do on social media for a minute, Mauricio.
So let's assume you cannot advertise, right? Because this is only in situations where you cannot advertise. So you cannot, I think this one's obvious, although some people blow this one too. You cannot offer your deal on social media, right? You can't be placing your business plan or saying, hey, I'm raising $1 million, call me, call this number, directly with that deal. That's an absolute no-no. And I do see some of that still, but I think that's the minority. But that's a definitely no-no. And it's also a no-no on your website, by the way. People forget the websites are public. So this applies both to your website and your social media.
Now we're talking 506B.
We're talking 506B, correct, or any other exemption that we come up with that you would be prohibited from advertising or soliciting.
Correct. So 506C, you can advertise, guys, but what we're talking about, right, is the 506B, friends, family, people you have a substantive relationship with.
Correct.
Okay, so
Yes.
so you can't put it on social media. You can't do it on Facebook.
Right.
You know.
What people forget and don't understand, because again, this is kind of a legal thing, is that an offer is, again, just like a security, very broadly defined. And it not only includes a direct offer about your deal, but it also includes what's called conditioning the market. And conditioning the market essentially means you're drumming up interest. Anything that drums up interest about your property or your project is going to be considered conditioning the market, which is going to be considered an offer. So when you post something like, hey, I'm super excited about, this, we're doing due diligence on this property. I'm super excited. Our investors are really going to kill it with a 20% ROI or whatever. And you start talking about just, that kind of stuff, that even though you're not directly talking about your fund and you're not saying I'm going to raise $1 million, you're drumming up interest, you're conditioning the market. And think about it. Why are you posting that? The only reason you're posting that is to drum up interest so that people would then hopefully contact you and get into your next deal, or if you're currently raising.
Okay, so you can't do that even if you're not going to present your current deal. You can't do that even for a future deal.
You can't do that at all. That's
you can. So conditioning the market or drumming up interest, which is what just about everybody in this business is doing on Facebook, is blatantly illegal.
Correct. That is correct. They are doing. People aren't realizing that the social media counts as marketing. I don't know what the thought is, or they're not talking to their lawyers. But the only thing you really can talk about if you've got a deal going is really information about your company, right? Hey, this is what I do for a living. I've got a private equity firm or whatever, and we invest in real estate and this, that, the other. The way I would recommend you guys capture people's email and contact legally is, and you and I are both proponents of this, Rauld, is add tremendous amount of value, put a report together. Hey, why real estate is a great asset class, why Florida is a great market, why mobile home park, whatever. And then just say, hey, for a free report, email me. And now you've got their contact. And then remember, you go through that process to take them from a complete stranger to a substantive relationship.
Questionnaire, the whole thing. So just to circle back, because this is a really big deal, because this is definitely being abused. So if someone is out there on Facebook bragging about their deal, the SEC looks at that as conditioning the market.
Correct. And even I don't like, so even things like a lot of people say, hey, we're sending out checks, or we just closed on checks. Or we're sending out checks. Again, why are you posting that? Like right. If something, well, I'm communicating with my investors. Like, well, why would you communicate with you? Why would you take an ad out in the New York Times to communicate with your investors, right? You would, obviously the only reason you do that is to drum up interest in order for somebody to contact you for your next deal and say, oh, wow, Rauld gets 15% returns for his investors. Wow, I should give him a call. That's the only reason you're doing it. So
if somebody says, like, I raised a bunch of money in a short amount of time, that would also qualify as
drumming. Why would you say that? The only reason you're saying that is to get people to come and call you. So you want to be really careful about all that stuff. If you want to be really black and white and stay safe. If
you're ever going to do a 506B.
Yeah.
So like us, we do 506Cs. If we stick with that, there's never an issue. But if we do a 506B, I suppose, I suppose some of these things that I'm guilty of, no question I'm guilty of, it would be a problem if I did a 506B.
Well, you walking through that process. So you definitely want to make sure that your CRM, you're identifying how you obtain these people. So you're doing 506Cs. If you're doing both, or you're doing 506B, you want to make sure that you tag them or whatever your CRM does, or highlight them if you're using an Excel spreadsheet. Make sure you know where they came from. Hey, I got this person from a Facebook ad. I got this person because he saw me speak. I got it from the podcast, whatever. That way you
drill down on that. Actually drill down one by one before you accept them in your 506B to see where they came from. And if they came from your Facebook bragging, that's an issue.
Right. Unless you've gone through that process. And
Right.
a lot of my clients actually even go to the extent with their permission to actually record again, because it's going to be your burden, right? The burden's on you to prove if it ever gets challenged, it's your
Right.
burden to prove that you went through this exercise. So you've got to keep really good records, keep a copy of the emails. That's why email is great. And on phone calls, because obviously nobody knows what the conversations were, either you put together a little, summary of your meeting, or some people just hit record with their permission and they have that stored. So if it ever gets challenged,
That's smart. Yeah, that's smart.
On this day, on that day, and this is the recording, and I did, so they can prove all that stuff. And so once they say this day, I got to know Rauld really well, I have a substantive relationship, then you can send them the next deal.
Yeah, guys, now I know some of your toes are curling, and I'm going to tell you, this will never be an issue until the market goes south and deals go south. That's when everybody goes back and says, hey, you didn't do this, this, this. And the SEC, raises, it's like poking a bear. You poke the bear with a couple of complaints, you were in big trouble. So,
Yep.
So would you agree with me on that, Mauricio?
I share that concern, not only on this part, but just on so many different things that we don't have time to go into every single detail. Right. But a lot of things I think are going to get unraveled or unveiled once. I don't even think the market has to go down. I think if the market just kind of flattens out a little bit, a lot of these things, like, not to get into detail, but the pro formas I'm seeing in terms of these elaborate assumptions people are making on rent growth and all that stuff. If you don't get that rent growth and it just stays flat, which I'm
hearing is already happening on deals. I just heard that about, one of my competitors in the thought leadership space. People were telling me in his deals that's happening. It's flatlined and people are upset because the returns aren't there. Yeah, I don't disagree. And again, we're not trying to scare you here. And Mauricio, I'll probably have you back on, and maybe we'll do that scare the shit out of you episode. just totally focused on that. Probably be my highest listened to episode anyway. So we're going to plan that one. I want to do that one for sure.
Let's do it. All
right, but all right. So the other thing we were going to chat about was the commissions, because I get this a lot. I want to raise money for other people's deals. Can we speak to that?
Yeah, I always joke. It's like, how do you raise money for other people? And the answer is, you can't. Well, you can't. I mean, I always joke, because I'm a big believer in, you always want to ask better questions, right? You don't say can't do this, can't do. You want to say, how can I do this? How can I do that? But let me just backtrack. So in general, the only way really you can get compensated for raising other people's money is if you're an SEC licensed broker dealer, right? Which nobody obviously is. It's not difficult, but it's time consuming. You got to take exams, there's compliance, it's cost, and that's not what you're going to be doing unless you want to do this for a living. So that's not an option. People you probably know this, Rauld, people try and get around the rules by coming up with these nonsense things like, oh, it's a marketing agreement, right? Or it's a consulting agreement. So they're not really paying me to raise money. They're paying me for these marketing. First of all, most of the time they don't do any marketing, obviously. They don't even have a marketing contract. But even if you did have a marketing contract and you did lay out everything that you are claiming you're doing, same thing with the exemption. It doesn't matter what you call it, marketing agreement, consulting agreement, whatever. The SEC is going to look through that and say, well, what did you actually do? And again, it's going to be your burden to show, hey, I did these 10 things for marketing services and I got paid commensurate with that. I mean, if I'm getting paid $1 million for 2 things I'm doing, that doesn't make sense. So people who try and get around that, that's another issue, which is also illegal. One of the ways that you can do it, and this is kind of it's legit, but it's got some hair on it, is what I call fund of funds, right? Where Rauld, you can legally put together your own fund, raise the money to your own fund, do a PPM, comply with the securities laws, and then turn around and invest that money into my deal, right? You turn around and now your LLC is my investor, and you put in $5 million or $1 million or whatever. And you can then get compensated for doing whatever you did at that level.
Two PPMs going here.
That's right, 2 PPMs going, and you can get compensated at that level for legitimately raising the money for your account, right? And acquisition fees, and a lot of times clients negotiate better terms because, hey, you're coming in with a huge amount, $5 million. Maybe you're getting a couple of more points as a preferred, and so there's ways for you to get compensated. The challenge that I've been really coming up against is that even though that portion of it is legal, think about this, Rauld. Typically, you're investing in real estate, at least in my world. You're investing in real estate, right? And you don't need a license to invest in real estate, right? But when you're doing a fund of funds, what are you doing now? You're investing in a security. You're investing in somebody else's stock, in this case, LLC. So it's another LLC unit or a partnership. So you're actually investing in a security as opposed to real estate, okay? It's a very subtle difference. And so the question comes up, do you need to be a registered investment advisor now because you're making recommendations to go invest into somebody else's shares in a company versus
I get it. Yeah, I get it. I get it.
And the challenge with that is that, it's not really a federal issue because you don't really worry about the feds until you're over 100 million. I mean, I've heard now 25 million, there might be some requirements, but essentially it's a state by state issue. So now I'm like, great, I got to go talk to a state attorney, a securities attorney that specializes in the Advisory Act. Long story short, there's a lot of exemptions within each state, but there's still a lot of compliance, audited financial reporting and what have you. So it's just really, if you're thinking about doing a fund of funds, just understand that you may be required to either register or there's some compliance stuff in your state. So remind me, Rauld, you're in Florida, right?
Yeah, in Florida.
Yeah.
But are there a lot of people doing this? Because I haven't even. Oh, okay, actually doing multiple funds.
Yeah, it's easy for them to raise money, and so they partner with an operator, and the way they get compensated, I'll raise the money, and then I'll give you the money, and then you run. I don't know much about.
So they do this. So I'm the equity raiser. So I do a fund. Can I use that fund for multiple deals and just keep it evergreen going?
Sure.
Okay. They only have to do it one time. But I see the nuances. If that gets litigated, I could totally see the argument that it's security, not real property. So what about these guys that are bringing $500,000 to $1 million to a deal and and joining in on the GP?
Right. So that's really the way you do it. So, but again, you got to be very careful. So bringing somebody in as a legitimate, and I want to stress the word legitimate, co-sponsor or co-GP, whatever you want to call it, then you can obviously, that opens up the world. You can now access their investors, but they're not getting compensated to raise the money because the rule is you cannot pay someone unless they're a broker dealer, and that payment can be cash, shares in a company. It doesn't matter what type of compensation. If you give a GP, a third or 20% of your share, it's still compensating them in the form of shares or membership units as opposed to cash, but it's still compensation. So they have to come in and legitimately do work. They have to be a co-sponsor. They got to, whatever you guys are doing, underwriting, due diligence, walking the property, talking to the attorney, the CPA, the investor relation, whatever your cut of that responsibility.
Sure. As you know, deals get carved up a lot of different ways. Okay. There's when you get a bunch of guys together, they're going to take down a $20 million deal. It's carved up based on who brought the deal, who raised the equity, who's going to do the asset management, who puts up the at-risk capital, who puts their resume to qualify the deal. And it can be very, very complex, and there can be multiple people in each one of those categories. But what you're saying is, let's say somebody comes in and they're bringing $1 million. By God, they better be in some of those other categories too, then, is what you're saying.
Yeah, all those categories you mentioned, there was one that I didn't like, which you said, if somebody brings in the equity or somebody brings in the money, that's the problem. You cannot give them any percentage for that. They have to be just for that. That can be a byproduct of, obviously, if you're a co-sponsor, you're raising money and you're getting compensated, but you're not getting compensated for the active rate. Think about it. If you're a syndicator, you're not getting paid to raise your money. You're getting paid for finding the deal and doing the value add and renovating, doing all that. So
the way I described it even gave you discomfort.
Yeah, because the easiest one, the one I like the most is the last one you did. When people get brought in as KPs and they have to guarantee the loan or whatever, that's a huge responsibility. So if you give them a third of the GP just for signing on the loan, absolutely, that's totally reasonable because it's a huge thing. And obviously if they're doing work, but you cannot give them, and certainly you cannot, and this is what drives me nuts, is negotiate that ahead of time. Hey, for every 100 grand you bring in, I'll give you 1%, or if you can bring in $1 million, I'll give you this. I mean, that's transaction based. That's an absolute no-no. And here are the challenges, Rauld. There's challenges on the side of the person receiving the money, which I honestly don't care too much about, but they're in violation of the law. They're practicing basically just like practicing medicine without a license or law without a license. They're being a broker dealer without a license. So they probably won't be able to get paid if they get nailed because you're receiving illegal compensation. But on the syndicator side, which is who I represent, the concern is, number one, you are obviously not disclosing that, right? Why would you be disclosing an illegal act? So now you're not disclosing that you're paying this person a commission or whatever based on money raises. And and not to scare about anybody, or maybe we should scare people, is that you are likely going to be required to offer what's called rescission rights, which is essentially return investors' money with interest. So essentially become a guarantor of the investor's money. Like, as a syndicator, how many of you want to be?
I'm sorry, you lost me. And if you lost me, I know you lost other people. So explain the situation and what's the possible ramification, just so I'm clear.
Yes. So the issue is you're failing to disclose the fact that you are giving somebody commissions, or you're paying somebody to raise money, right? You wouldn't disclose that. You're not going to disclose that, right? Because that's an illegal activity. So you don't disclose that. And so now you're engaged in an illegal offering because you failed to disclose that. And one of the remedies, the most likely remedy, the minimum remedy, and mostly the most likely, is your responsibility to return the investor's money if they want out. So you have to return invest. So even if the deal goes south, no fault of your own, the market turned, you did a good job, you acted reasonably, because you failed to disclose that, you are going to be required to return all of the investor's money, assuming you have it. Obviously, you may even file for bankruptcy or whatever. But the consequences are you are now responsible not only to return their money, all of their money, but also whatever interest rate they've been accumulating over those years. So it is a pretty hefty penalty. In addition to, I mean, obviously, potentially, when you have an illegal offering, there are jail time, civil penalties, whatever. But most likely, it's a, not to say just rescission, but you are most likely going to be required to return the investor's money, which, again, in my mind, you're guaranteeing the investment, right? Because if the investment goes well, great, they make money. If the investments go south, you've got to return all their money. So essentially,
this is essentially because of a failure to disclose.
Right. And then the other issue that actually has come up recently, I'm actually dealing with it right now. It's not one of my clients, but they're coming to me now, is because you can't put this in writing, right? It's not like, hey, Rauld, let's get into a contract where you raise $1 million, I give you 5%. So what if there's a dispute? What happens? Something happens even before the close, and now the person backs out or whatever, and now it's like, well, I promised to pay you 20%, and you're in the documents, but now you're not helping me, so I want to reduce that amount. And you obviously don't have anything in writing. All you have is an operating agreement or the PPM or whatever that shows that I'm a 20% owner. So you're responsible to give me that 20%. There's nothing in writing because there's nothing that you can put in writing in terms of, the arrangement that we have that, hey, you bring in the money and I give you 20% of the company. So it just opens up a ton of a can of worms.
Interesting. Well, I see some real hurdles as an operator, just personally, with what you just said. And so, it's something I really want to take a look at because, certainly when you put 5 to 10 people together and they're all raising money, how do you carve it up? If the equity is not a piece of it. So that's an interesting conversation.
Well, again, you're bringing them in because they're adding some type of value, either knowledge or, grunt or whatever their expertise is, but you're not bringing them in because they can. Legally, you can't bring them in because they're raising the money. So whatever else they're doing, it doesn't have to be equal. If you have 5 people, you don't have to each be doing, 20% of the work. I can be doing 5 because I'm not doing as much. I've got a day job. I don't have time to do all. I'm just going to handle the underwriting. And so I'm only going to get 5%. Oh, well, I have more time. So I'm going to be boots on the ground. I'm going to travel. I'm going to get on a plane and travel and walk all the units. Well, you're going to get a little bit more. And you're going to be, hey, you're investor relations guy, and you're going to handle the investors. And okay, you're another 10%. All those, that's how you divvy it up. But you do not divvy it up as, hey, I raised $1 million.
Right.
Got it. So,
that makes sense. Okay. Wow. So this is, we're out of time, but what an awesome interview, brother. I really appreciate you being on the show, and really looking forward to getting to know you better. It's been a lot of fun for me. So thank you. And we will talk soon.
Thanks for having me. Really appreciate it.
You bet.
Hey, thanks for watching. Please subscribe to my channel. And if you listen to podcasts, join me on iTunes, Stitcher, or wherever you listen to those podcasts. Just search for Lifetime Cash Flow through Real Estate Investing.